Welcome, the learner. You're here because you want to get smart, fast, and maybe without feeling buried under information.
Exactly. And that's what this deep dive is for. We take a whole stack of sources
Yeah, a big pile.
and we pull out the really important stuff, the golden nuggets.
The goal is those aha moments delivered quickly.
And today we're diving into corporate credit, specifically raising capital based on Derrick Whitehead's ideas.
Right, we've got a YouTube transcript and article summarizing his viewpoint.
Our mission really is to get past the usual online chatter about like getting a $5,000 credit card
Yeah, the basic stuff.
and really understand how a business, maybe even starting from scratch, can build serious credit and access significant funding.
Okay, let's unpack it. Whitehead seems to have this three-level framework, and he basically says most online advice is stuck at level one, that few $1,000s you mentioned. We want to go way beyond that.
It's about building a foundation for real growth, not just small steps, but positioning for, serious capital, big investment.
And the first big decision, according to him, it's the corporate structure.
Yeah, he's very direct about this.
He says, avoid the LLC if you want serious money. Go for a C Corp.
His reasoning is, well, he says banks don't like limited. Not when big money's on the line. Seems he used to advise banks, so.
That makes sense. A C Corp feels more, I don't know, substantial,
Yeah.
more separate.
Well, the liability aspect is key. With a C Corp, there's that clearer separation, which banks might see as the owners being more committed, especially for larger loans. Their interests align better, maybe.
He even has these terms like Mama Corp
Yeah, the main operating company.
and special purpose entity, just for getting money.
Right, it shows you need to be intentional. Think about funding right from the start.
It really makes you think, doesn't it? How does your structure line up with where you want to be financially down the road?
That's Whitehead's point exactly. Get it wrong early, and you could be creating roadblocks for yourself later when you need bigger capital.
Okay, now here's where it gets really interesting for me. This idea of an aged corporation.
Ah, yes.
Banks don't like rookies, he says. Brand new companies. They prefer companies with, what, 2 or 3 tax years behind them?
Yeah, that history suggests stability. It looks less risky to a lender, even if there wasn't much activity, just having those filed returns.
It implies you've existed for a while. You didn't just pop up yesterday.
Exactly. Perception is huge here.
But there's a catch, right? He warns about cores that are too old.
Right, like older than 8 or 9 years
Yeah.
with no recent activity.
Why is that?
Banks might see them as dormant, obsolete. Like, what have you been doing all this time? And they want to see something active, ongoing.
Right. So if you don't want to wait years, he suggests a shortcut.
Acquiring an aged corporation lets you skip that new business waiting period.
Clever. But you'd have to be careful, right? Check its history.
Oh, absolutely. Due diligence is critical. Make sure it's clean, properly set up. But yeah, it can definitely speed things up in terms of perceived credibility.
Okay, so you've got your C Corp. Maybe it's aged. Now building credit. How does that start?
He outlines this initial phase using personal guarantees, PGs.
On credit lines, how much are we talking?
Around, say, $25,000 to $50,000 initially. You have to leverage your personal credit at first because the business itself has no history yet.
Okay, so you use a PG to kick things off.
Right. And crucially, you let that activity report to the business credit bureaus.
Before you do anything else?
Yes. Let it show up. That starts building the business's independent credit profile.
Yeah.
It shows you're managing debt responsibly.
And then you move on to unsecured cards from different banks.
Exactly. But, and this is important, he warns against credit card stacking.
What's that? Just applying for tons of cards really fast.
Yeah. He says aim for maybe $150,000 total in that initial unsecured push, and then pause. Let that report.
Why do I pause?
Because applying for too much too quickly looks desperate. It's a red flag for lenders. They might think you're in trouble.
Ah, okay. Slow and steady wins the race, kind of.
A more deliberate approach, yeah. Show responsible usage over time.
And as you build more credit, who should you target? Any specific types of banks?
He really emphasizes credit unions and community banks.
Why them?
They can be more approachable, maybe have slightly different lending criteria than the huge national banks, often more focused on local businesses.
Interesting. And he even mentioned something called a foreign filing.
Yeah, that's a bit more advanced. It's like registering your company to do business in another state.
Why would you do that?
To potentially tap into a more favorable lending environment there. Maybe the community banks in that other state are known to be more receptive. It's strategic.
Wow. Okay. So it's not just about the numbers. It's also about strategy and Perception.
Perception is absolutely key, he says. You have to make your corporation look credible. These are his data points.
Right. It's about signaling legitimacy, stability, professionalism.
Exactly. Lenders are looking at the whole picture.
So what are these data points? He listed quite a few.
Okay, first, a physical office. Not your home, not a P.O. box.
A real address. Got it.
Second, a landline phone. Not just your cell or Google Voice or only an 800 number.
A landline first.
Really? That's what he recommends.
Yeah.
Landline first, then maybe add an 800 number. It just looks more like a permanent fixture.
Okay. What else?
An established website. Active. With a professional domain, not Gmail or Yahoo, for your business email.
And you can check its history.
Yeah, using whois lookups, see how long it's been around, if it's active. It adds to the story.
Makes sense. An online presence is vital now.
Then getting listed in business directories. He mentions Manta as an example.
Wow. It's visibility.
And this one's interesting, having multiple corporate officers. President, VP, secretary.
Secretary. Why is the secretary important?
He highlights that role.
Yeah.
Suggests a more structured setup, I suppose. And the secretary handles important corporate records.
Okay, so multiple officers signal a more robust structure.
Seems to be the idea. And finally, a current, good-standing letter from the state.
Showing you're legally compliant. And it needs to be recent.
Yeah, preferably less than 6 months old when you're actually seeking funds.
Yeah.
An old one is another red flag.
That's a lot of details to manage just for perception.
It all adds up to build that picture of credibility.
Okay, so perception is handled. What about the actual credit reporting? He mentioned bureaus.
Right, not just one or two. He says you need to register with 5 key business credit bureaus.
5. Which ones?
Experian Business, Equifax Business. Then the SBFE, which is the Small Business Financial Exchange. That's where banks share data directly.
Okay, SBFE.
Dun & Bradstreet, of course, the big one. And Paynit.
Why all 5? Don't they have the same info?
Not necessarily. They track slightly different things or weigh them differently. Being registered everywhere gives the most complete picture, especially the SBFE, showing how you handle bank loans.
Got it. Cover all your bases.
Mm-hmm.
So you've built credit, you look credible. How do you actually get, the big funding?
Well, as your corporation builds value, maybe it acquires assets, generates revenue, and shares become valuable.
The actual stock in the company.
Exactly. And that's where the corporate kit comes in. Costs maybe $125 or so.
What's in it?
The physical stock certificates. You need those to actually issue shares to investors when raising money.
Ah, the tangible proof of ownership.
Precisely. It's fundamental for equity financing.
And for bigger investments, you need more documentation, right?
Definitely. Professional stuff. First, a pitch deck.
Like a presentation summary?
Yeah, concise, compelling, gets investors interested.
And second,
The PPM Private Placement Memorandum.
that sounds serious. Legal.
Very. It's the detailed legal document. Outlines the investment terms, all the risks. It protects everyone involved. Ensures compliance.
Compliance with SEC rules.
Yeah, he touches on SEC regulations. Specifically Rule 504.
What's that?
Allows you to raise up to $10 million. It's an exemption. Makes it easier than a full public offering.
$10 million is pretty significant.
It is. And then there's Rule 506.
What does that do?
That lets you raise unlimited funds. But typically after you've had some success under 504, think of 504 as a stepping stone. 506 removes the cap.
Okay, so there are defined pathways for raising larger amounts privately.
Right. These rules make it practical for growing businesses.
Are there other funding routes besides selling shares directly?
Oh, yeah. He mentions crowdfunding, obviously.
They've become pretty common.
Also, the idea of starting your own investment fund, if you get to that level.
Really? Your own fund?
Yeah. And working with boutiques, specialized firms that help companies raise capital.
Boutiques? Like investment banks?
Smaller, more specialized ones. Often. He makes a funny historical note about them evolving from old boiler rooms.
Huh. Okay, so the industry has cleaned up its act a bit.
Hopefully. But yeah, these boutiques have networks and expertise.
And for the really big leagues, huge amounts of capital.
He briefly mentions acquiring publicly traded shell companies.
Shell companies? That sounds shady.
It can be complex, but it's a known strategy. It's done through a reverse merger.
Yeah.
Your private company merges into a public shell.
And that makes your company public instantly.
Essentially, yeah. Without a traditional IPO, it can provide massive access to capital markets very quickly. Very advanced, though.
Definitely sounds advanced. Yeah. Okay, shifting gears slightly. He talks about mindset too, right? Micro and macro goals.
The micro goal he suggests is becoming an accredited investor.
What does that mean again? Having a certain net worth or income?
Yeah, typically over $1 million net worth, excluding your house, or income over 200K single, $300K joint for the last couple of years, plus some financial sophistication.
And why is that a goal?
It opens doors. Accredited investors can access investments not available to the general public, usually higher risk, higher potential reward stuff.
Okay, so that's the micro. What's the macro?
The macro is thinking bigger, pursuing billion-dollar opportunities, not getting stuck thinking small.
So expanding your financial horizons, challenging your own perceived limits.
Exactly. Realizing that huge capital is available if you're positioned correctly.
This leads into some really advanced stuff you mentioned. Notes and debt.
Yeah, he says notes are where the really big money moves.
What kind of notes?
Specifically non-performing notes. Bad debt, basically. Loans where people stopped paying.
Banks sell those.
Oh, yeah. They want to get them off their books.
Yeah.
They sell them for pennies on the dollar, sometimes as low as like 3 cents on the dollar.
Wow. 3 cents for a dollar of debt.
It happens. It's risky, of course.
Yeah.
But it creates opportunities.
What's the opportunity? Just collecting the debt.
That's part of it. But the strategy he outlines is more nuanced. You buy the bad debt.
Okay.
Then you work with the borrower, maybe offer a modified payment plan they can afford, maybe forgive some principal. You help them make the debt performing again.
And clean up their credit, maybe?
Could be part of the deal.
Yeah.
And once that debt is performing, meaning payments are being made reliably, that performing note becomes a valuable asset. You might even be able to use it as collateral to get bank loans yourself later on.
Whoa. So you buy bad debt cheap, fix it, and it becomes a valuable asset.
That's the core idea. Turn non-performing into performing.
He also mentioned doing this with real estate debt.
Right. Buy distressed mortgages, then work with the homeowner. You essentially become the bank.
Offering them a new mortgage or modifying the old one.
Exactly. You control the terms, collect the interest. It can be a path to significant wealth.
Fascinating. And one more advanced thing, reassigning debt between your own companies.
Yeah, if you own multiple companies, you can legally reassign debt obligations between them.
Why?
To help build the business credit profile of one of the entities. It shows financial activity and management within your portfolio. Again, pretty sophisticated stuff.
It really sounds like a different language.
That's exactly what Whitehead calls it. He says understanding and using these strategies is like speaking Latin in finance.
The language the big players understand?
Moving beyond the basics.
Okay, so let's try to recap the key steps he laid out for building this fundable corporation. It felt like a lot.
It is quite a roadmap. It starts with choosing that C Corp structure.
Right. Maybe getting an aged one 3 to 8 years old seems ideal.
And building your personal credit first. That's foundational.
Then build business credit, start with PGs, let it report.
Then move to unsecured, but carefully. Aim for maybe 150K, then pause.
Target credit unions, community banks.
Right. And work on credibility. The physical office, the landline.
The website, business listings, multiple officers.
Fit your EIN, of course.
And be careful with the business name and SIC code.
Yeah, choose something general. Research codes banks like and dislike. Don't use a bad name on the EIN application.
Keep that good standing letter up to date.
Crucial. Then build trade lines. Get suppliers reporting your payments.
Aim for 5 to 8 trade lines. Paying on time for an 80-plus Paydex score.
Or pay early for 90-plus reach, even better. And monitor all 5 bureaus constantly.
Experian, Equifax Biz, SBFE, DNB, Painted. Got it.
Use letters of intent. Build relationships with bankers.
Understand the corporate kit, the stock certificates. That's how you actually raise equity.
Prepare that pitch deck and the PPM for investors.
Explore crowdfunding. Maybe build your own fund someday.
And consider those public shelves for massive growth, if that's your ambition.
Wow, that is a comprehensive list.
It really covers the journey from starting out to potentially playing in the big leagues.
So the learner, I think the big takeaway here from Whitehead's perspective is, well, if you build the right kind of company, the right structure, the right credibility,
and learn these more advanced financial strategies,
you can unlock funding opportunities way beyond what most people think is possible. It's a different level of thinking.
Yeah, it's a framework for thinking bigger and acting more strategically about finance. It's about really understanding the game.
Which brings us to a final thought for you. How could these ideas, shift your perspective on financing your business or future businesses?
Are there specific parts of this, maybe the aged core or the debt strategies, that make you want to dig deeper?
Think about the difference between just being told how finance works and really grasping the underlying mechanics, the Latin of it all.
because they have deeper understanding.
Yeah.
That's where real financial empowerment starts.